IAS 37, provisions, contingent liabilities, and contingent assets. It is not a big one, and we hope to have a very successful discussion. So we are starting right away. And you can see the name of the topic, of the standard is provisions, contingent liabilities, and contingent assets. So we have three things in one, and we are going to take them one at a time. So we'll start with provisions. Provisions. We've heard about provisions way from high school. Provision for doubtful debt, provision for depreciation. So what are they? Provisions. We are starting with this. So what are provisions? Provisions are liabilities of uncertain timing or amounts. Liabilities of uncertain timing and amounts. So we provide for those things. We know that there's going to be a liability, but we don't know when we will incur that liability and the actual amount. So we kind of estimate so that if that liability should actually happen, we would have something there set aside to take care of that liability. And because we don't know the timing or the amount, it can either be higher or lower. But either way, we estimate how much we think the liability is going to be. Okay? All right. Now, the objective of the standard is to ensure that appropriate recognition criteria and measurement bases are applied to provisions, contingent liabilities, and contingent assets, and that sufficient information is disclosed in the notes to the financial statements to enable users to understand their nature, timing, and amount. Starting with the provisions, we said they are liabilities of uncertain timing or amounts. And because they are estimates, we have to provide the users of the account with information such that whenever they read our financial statements, they would actually understand the nature and then why we have those amounts as provisions. Are we okay?
Sure.
Right. Now, the key principle established by the standard is that a provision should be recognized only when there is a liability, that is, a present obligation resulting from past event. So the standard aims to ensure that only genuine obligations are dealt with in the financial statements. All right.
Okay.
For example, we have a court case. And then from the advice of our lawyers, they are certain that we are going to lose the case. Okay, they are not certain, but they, looking at the evidence and things surrounding the case, we may lose it. So they will kind of estimate our probability of losing. And we have to prepare towards the loss so that we will have something set aside to take care of damages and all those things. So we provide for such things. That is all what provisions are all about. Now, we've already defined what a provision is. So we continue with the recognition of provisions. Yeah. An entity must recognize a provision if and only if three things are met. So for provisions, their recognition, we have three things that must be met. The first is that it must be a present obligation as a result of past event. That is the first. The second is that the payment must be probable. Probable. That is, it is more likely we will pay. And the final thing is that the amount can be estimated reliably. So amount can be estimated reliably. So when these conditions are met, then we can recognize a provision in our books. All right.
Okay. Sure.
From the conceptual framework, they defined a liability as a present obligation resulting from past events, say that when we settle, it will lead to outflow of resources. All right.
Economic resources. Yeah.
Provisions is a type of liability. It's just that we don't know when it will happen and then the time and the amount that will be involved. So because of that,
Okay.
we provide for such a liability. Before we can recognize a provision, we must meet these three things. Because it is a type of liability, it must be a present obligation as a result of a past event. And the payment must be probable, which is it is more likely we will pay than not. All right. Then the amount must be estimated reliably. When these three things are met, then we can have a provision recognized in our books. All right.
All
Now we
right.
must know that all these three conditions must be satisfied before we can do a recognition of a provision. We must also know that no provision should be made for the future where no obligation exists. We can't say that in the future we are going to incur this cost, so we are recognizing a provision. There is no past event, okay, so that even disqualifies a provision from being recognized. Are we okay with that?
Sure.
Right. Now we move on with the measurement. Measurement. The amount recognized as a provision must be the best estimate as at the end of the reporting period of the future expenditure required to settle the obligation. So we have met the three recognition criteria. Now we want to look at an amount at which we should have the provision in our books. And the standard is saying that that amount must be the best estimate. So that means that we can have so many estimates, but it must be the best. I forgot to
Okay.
talk about something about at the recognition side. Now the obligation should be legal or constructive. Let me go back.
Okay.
This obligation should be either legal or constructive. All right.
Okay. So what does it mean?
All right. An obligation is legal when it is as a result of maybe some litigation.
Okay.
And if it arises because of your past practice, because it has created a valid expectation on the part of third parties. So you have a way of doing things, and out of how you do your things, it has created some expectation in the minds of people that, okay, whenever this is the situation, the company behaves this way. And that has created an expectation in the minds of people that, oh, the company will by all means do something about it. That is the constructive obligation. It is not legal, but because of your past event and how you do your things, it has created that impression in the minds of people. You understand?
Yes,
That
please.
is the constructive obligation. So, yeah, that is that. Are we okay?
Yes.
Good. So let me read something here. So there's an example here which says that a retail store has a long-standing policy of allowing customers to return merchandise within a 30-day period. It has become their practice. So whenever you buy something and there's some defect, you know that whenever you take it back within 30 days, it will be accepted.
Sure.
So that is an example of constructive. It is not legal, but
Constructive
because of how you conduct your business,
practices.
it has created
Okay.
an expectation. That is the constructive obligation. All right. Now let's continue with the measurement. So the first thing we should note here is that the amount must be the best estimate. Of the provision. That is one. And we have to take into consideration risk and uncertainties. In reaching the best estimate. All right.
Sure.
So usually you can't just get up and just pick an amount as your estimate. You need to get experts to read the circumstances surrounding the situation and in order to make this estimate, because the amount you are recognizing as a provision has to be the best estimate, taking into consideration risk and uncertainties. All right.
Okay.
Now let's look at some things surrounding this. They're saying that provisions for one-off events one-off events. So after we've made a provision or after the event has happened, it will never happen again, or we expect it to be one time. So
Okay.
provisions for such events, the standard says that they are measured at the most likely amount. Measured at the most likely amount. All right. Let's pick an
Okay.
example. Maybe there's an environmental cleanup lawsuit. We know that it is going to go against us. And in order to know the amount at which we would make a provision for that environmental cleanup lawsuit, it may be in the law that if you should be in breach of such an environmental cleanup, this is how much you are going to pay as damages. So we can refer from the law and then measure our provision at the most likely amount, which is what is stated in the law. If there is nothing like that, our lawyers can also read circumstances, refer to past decisions by the court, and decide on the most likely amount. So for provisions for one-off events, we measure the provision at the most likely amount. All right.
Okay.
Provisions for large populations of events are measured at a probability weighted expected value. So, for example, warranties and then customer refunds. Because it is not one off, we will put together all the let's say probable returns if it is customer refunds, and then we weight them and then come out with a measure or an amount for those provisions. So provisions for large population of events. So let's say customer refunds. Because you don't know the number of customers who will come for refunds, you do a weighted average based on the probabilities, and then you decide on the amount. All right.
Okay.
So this we measure at a probability weighted expected value. Good. There's a last one here. Now, both measurements are at discounted present value using a pre-tax discount rate that reflects our assessment of specific risks to the liability. So this is something we should note. Because we are going to incur these amounts in the future, we are providing for them now, so they should always be at the discounted amount. Now, our discount rate should be a pre-tax discount rate, taking into consideration our assessment of the risk relating to the liability. All right.
Okay.
Right. Good. So they're saying that in measuring a provision, consider future events as follows. That is another thing we'll look at here. So in measuring a provision, we should consider future events as follows. Future events. One, we should forecast a reasonable changes in applying existing technology. We should ignore possible gains on sale of assets, and then we should consider changes in legislation. So forecast. This is just a guide. We should
Okay.
forecast changes in existing technology. We should also ignore possible gains. On sale of assets, and then consider changes in legislation. Well, you see, if we should have a court case and we are still in court and we are at the end of the year and we hear that, oh, Parliament is going to make amendment to the law which may possibly affect or increase how much we are going to pay as damages, this comes into play. So it means the old law no longer applies to our case, but the new law does. Okay. So
Okay.
these are some of
Sure.
the things we should consider. Changes in legislation. Right. What else? What else? What else? What else? So these are all guidance we should follow. I think we've done almost everything. So let's look at something here and then. we move on.
Okay.
Now, when there is restructuring, restructuring is sale or termination of a line of business, or we are closing business locations, we are changing management structure, or we are fundamentally doing a total reorganization. We should make provisions for such restructuring. All right. I think
Okay.
we'll discuss the restructuring and then we move on to the disclosure. Restructuring. So it is either a sale or termination of operation. That is one. It can also be closure of business location. Could also be changes in the management structure. And it can also be reorganization. All right. Now, for each of these, what will be the provision? If it is a sale operation, we should recognize a provision only after a binding sale agreement. So after we've reached a sale agreement, then we can decide on our possible liability and then we make an estimate for it. If there hasn't been any sale agreement, we can't provide for the sale of the operation. Are we clear?
Yes, please.
Yeah. So provide or make provision only after a binding sale agreement. Okay. Now closure or reorganization. All right. For questions relating to provisions, they're usually scenarios, and then you'll be given some figures, and you just have to come out with the provision amount and why you think that is the amount. So you must understand issues from the standard. You can be
Okay.
given a very short scenario with some of them be sale or termination, closure, changes in the management structure, reorganization. And then from what we are doing, we know that if it is a sale of operation, you can only provide for or you can only make a provision only after a binding sale contract. So from what you have been given, is there a binding sale contract? If no, sorry, then no provision should be made. But if there is a binding sale contract, then you should make a provision. All right.
Okay.
Now,
Okay.
closure or reorganization, we are going to close down a business. What should be our provision? We should recognize a provision only after a detailed plan. Detailed plan is adopted and has started being implemented or announced. You see the keywords here: implemented or announced. So, if we are going to close down a business or reorganize our business, we should only recognize liabilities relating to the closure or reorganization only after a detailed plan has been implemented or announced. Now, the standard is telling us to note something, that a board decision of itself is insufficient. So we should note this. A board decision is insufficient. We should keep this in mind. So if maybe the scenario we've been given, we are told that the board has decided to close down the business or do an organization alone, it is not sufficient. We should see that there's a detailed plan
It's
which
a
has been
plan.
announced or which has already started being implemented. Then we can make a provision.
Provision for that. Okay.
Yeah. Now, future operating losses. Future operating losses are not recognized. No, provisions are not recognized for future operating losses. So no provision should be recognized. Should be recognized. You see how the discussion is going.
Sure.
Yeah. For future operating losses, no provision should be recognized. Now, for restructuring, provision and acquisition, on acquisition, the standard is saying that you should recognize a provision only if there is an obligation. Only if there is an obligation at the acquisition date. All right. So these are some few scenarios and how we would, whether we should recognize a provision or not. We've talked about
Okay.
restructuring, which can take four forms, either a sale or termination. We are closing the business, we are making changes in our management structure, or we are reorganizing. If it is a sale of operation, we should only make a provision after a binding sale contract or sale agreement. If it is closure or reorganization, we can only have a provision only after a detailed plan has been announced or is being implemented. A board decision is insufficient. All right. Future operating losses, there should be no provision. All right, let's continue. So for future operating losses, no provision should be recognized. And if we would restructure on acquisition, we should only have a provision recognized if there is an obligation at the acquisition date. All right.
Okay.
All right. So I think we'll continue with the disclosure and then we close our discussion on provisions. So what should we disclose? Disclosure. First, we should disclose opening and closing balance and movement in the provision. opening and closing balances, and movement in the provision. So the movements can be an increase or a decrease.
Sure.
All right. Then we should also disclose a brief description of certain things. What are they? The nature of the obligation, that is one. Two, expected timing of any settlement. Three, indication of the uncertainties surrounding the amount and timing. All right, so we are done. This is all
Okay.
for provisions.
Provision.
We should disclose the opening and closing balances and the movement in the provision. And the movement during the year can be an increase or a decrease. We should also disclose a brief description of the nature of the obligation, the expected timing of any settlement, and then indication of uncertainties surrounding the amount and the timing. Please, any question?
Fine.
Okay. All right. There is something I missed. The use
Okay.
of the provision. Provisions should only be used for the purpose for which they were originally recognized. You can't provide for doubtful debt and then you use that provision for depreciation. No. What you have provided for, use the provision for that purpose. Now we should review it at each balance sheet date, and that is what will bring about the movement, whether an increase or a decrease, taking into consideration the risk and uncertainties. And if it is no longer probable that there's an outflow of resources to be required to settle that obligation, the provision should be reversed. So we provided for
Yeah.
something, but
Okay.
where we've gotten to, it is not probable we will actually incur that obligation or that
Okay.
liability. We would simply reverse the provision. That is all.
Okay. So I can say accruals are the same as provisions, right?
No,
Can that be?
no. How do I explain this? So when you accrue something,
Yeah.
let's look at it from an expense perspective. If I accrue an expense, I have enjoyed the benefit, but I haven't paid for it.
Paid for it.
Yes.
Okay.
I don't make provisions for electricity I owe. I know I owe it, so I will pay.
Okay.
But the provisions we are providing for, good, let me use this SHS example. That is how my accounting teacher explained provisions. It was like one afternoon you are back from school and you want to boil some yams. But your kid brother isn't around. So you decide that let me add some pieces. I want to take about 6 pieces. So let me add
Yeah.
about 2 or 3.
Okay.
If by the time the yam is ready and he's around, I don't lose. I have my 6 and I'll give him the 3.
Yeah.
If he comes and okay, if the food is ready and he isn't around, I was going to eat 6. I have how many in addition? 3. All right. But if the food is ready and he's around, I don't lose. I still have my 6 and I give him the 3. So if my
Okay. Yeah.
kid brother isn't satisfied with the 3 and he wants one more in addition, then I can make or take that out from what I have and give it to him. But I actually provided for 3, which I will give him, and I don't lose from the 6 I decided I would eat.
Okay.
So that is how the provision is. But accruals, you are sure that this
Okay.
month I didn't pay electricity, and this is my bill, 100 Ghana cedis.
Okay. Okay.
I will pay
Okay.
it. You know you have to pay. But the
Okay.
provisions, you are not sure whether
The
you,
amount involved.
yes, and even the timing. So it is more of estimates. You estimate
Okay.
that, oh, next week this may happen, so let me provide for it. Or like the court case, the lawyers tell you that it is probable you will not win. So you start making a provision at the end of the year that, okay, if I don't win, what is the probability that I don't win? About 60%. You can provide for the losses.
Yeah.
But you are not even sure the amount that will be involved and then the timing. But you are just putting things in place so that if it should happen, you won't lose so much. Like the food example, like if your kid brother comes and he's hungry, you give him the 3, you still have your 6. If he comes and
Okay.
so you are providing for you not eating less than you plan to eat, which is your 6. You add a
Sure.
3 for him. If he comes and he's not hungry, you add a 3 to yours and you have like 9. You've even gained. So do you get it now?
Yes,
So
please. I get
accruals
it.
are things you owe, and you are
Yeah.
certain of their amounts, and even when you have to pay them. Because if
Okay.
there's an expense you have to pay, and you have 2 weeks to pay, you are even sure of the time and then the amount involved. That is something you've accrued or you owe. But provisions, you are not sure of the timing and the amount involved. So because of that, you are making plans towards that obligation if it should happen.
Okay. I get it.
Yeah. So this is all for provisions.
Okay.
And contingent liabilities and contingent assets, they are just rules we have to follow
Okay.
and straightforward. We'll finish very soon.
All
Okay,
right.
so contingent,
I'm actually enjoying the discussion. Yeah, because frankly, on the job, you see, ours is more of practicing. So you meet with some of these stuffs.
yeah.
Yeah.
And
Yeah. That's why I want to get myself
I
clear.
remember is it advanced audit or the principles of audit?
Okay.
Provisions are very, very key in the audit because
Sure.
if the estimates are wrong, it can affect the financial statement because you see,
Yeah.
provisions are less from the profit, isn't it?
Yeah. Exactly.
Yeah. So if they are making very huge provisions,
Uh-huh.
it is going to reduce their profit
Use the
and
profit.
it has
Exactly.
an impact on tax.
Exactly.
So provisions are
Exactly.
very, very key in audit situations. And that is why, if I remember it right, taxation, they, I think they disallow general provisions, if I'm not wrong, something like that. But if it is specific, it is allowed, but the general provisions are all disallowed, if my memory serves me right. Good. What about contingent
I believe.
liabilities? You see, contingent, the liability you are going to incur is dependent on something.
Yeah.
contingent liability. What is it? It is a possible obligation. Possible. Please hold on it.
All right.
Right, let's continue. A possible obligation. When we were talking about provisions, what did we say there? A
Uncertain.
liability of uncertain timing or amount. You see,
Amount.
they are uncertain.
Mm.
But this one, it is possible.
Okay.
So that is contingent obligation, a possible obligation that arises from past events. So it is a possible obligation. It is also arising from past events. Okay.
Okay.
And their existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future events. So their occurrence, let me put it this way. Their existence will be confirmed by the occurrence or non-occurrence of one or more uncertain future events. Not wholly within the control of the entity. All right, let's look at the definition again. A possible obligation arising from past events, but the existence of the obligation will be confirmed by the occurrence or non-occurrence of one or more uncertain events, not wholly within the control of the entity. So this is contingent. The obligation is possible, but it depends on some other uncertain event happening.
Okay.
But the entity doesn't have control over that event happening.
Okay.
Please, do we understand?
Yeah. Yes, please. I get it.
Now, what must the entity do with contingent liabilities? The entity will just disclose the contingent liability. So for contingent liability, you should know that the entity will just disclose it, but will not recognize anything in the books concerning the contingent liability. Why is that? Because it arises from a past event, and it is not probable that an outflow will be required to settle the obligation. or the amount cannot be measured with sufficient reliability. So until that event which will make it happen happens, then we recognize. But if that is not the case, we only disclose information about it in the financial statements. So this is all for
Okay.
contingent liabilities.
Okay.
The possible
Can we
obligation.
take a practical example, something on that?
Let me see. Okay, let's use the court case. We have a case in court, and they are still looking for evidence. Okay,
Okay.
we are not sure at the moment if something will come up during the investigation that will make us lose the case. But it is possible something may be found which will make us lose the case. All right.
Okay. Okay.
So in this case, in this situation, we losing the case is dependent on evidence
The
that will
evidence.
surface in
Okay.
future. All right.
Okay.
And then that
Okay.
evidence that will surface is not in the control of the entity. So because of that, there will be a contingent liability. The liability may be incurred depending on that evidence surfacing.
Okay.
So I think this is
Yeah.
an example I can think of. Well,
Sure.
losing
It's
the
fine.
case depends on that event happening, and we don't have control over that. So that is something I can think about. So for
Okay.
something like that, we'll just disclose that, oh, there's still investigation going on, but we may incur this liability if this and this and this evidence is found. We just give information about it, but no provision is made. That is contingent liabilities. Final thing, contingent assets. It is the opposite of contingent liabilities. Contingent assets. So it is a possible asset. Possible asset arising from past event whose existence will be confirmed only by the occurrence or non-occurrence. So the opposite of contingent liabilities. Confirmed by the occurrence or non-occurrence of one or more uncertain future event. Not wholly within the control of the entity. Right. We can use the example I used for the contingent liabilities. We have a
Yeah.
case, and this time around, if certain evidence surface, we will win,
We are winning. Yeah.
and that will lead to the entity receiving some compensation. If investigations bring out that evidence,
Okay.
we get the money.
Yeah.
But we are uncertain that evidence will come out. So because of that, we just disclose in the books that, oh, if this evidence comes out, then we may get the money. So for contingent assets and contingent liabilities, we just disclose information about them. But for provisions, we make the best estimate taking into consideration the risk and rewards, the risk and uncertainties surrounding the situation.
Okay.
So this is all for provisions, contingent assets, and contingent
Okay.
liabilities. Yeah.
I see. So here, there's nothing about, say, calculation
No.
stuffs. More of.
Yeah.
Oh, okay.
We just disclose.
Oh, okay. Okay. It's. I'm enjoying it, frankly speaking.
All right. Great. So
Yeah.
this is all. We are done. So I'll pause this recording and then start a new one for
38.
IAS 38. Yes.
Okay.